Well, welcome to the fun and mentals of real estate. I got a question of the day for you. It's how can you buy rental property without a job? Is that possible? Oh my gosh. Today, we're going to dig into, in our investment series, on how to buy rental property. So we're kind of building to our model that we're going to need to filter all the different properties that are available to see what's going to be profitable. And one of the key things that we mentioned last week is how much cash am I going to need to buy the home? You have to back into the sale price of either a single family or multi-family that you want to buy. So we need to know how much cash we need, Glenn.
We do. We need to qualify and all that. And you know, the world is set up to make it very easy to buy your first home. That's an easier barrier of entry. There's down payment assistance programs, closing costs. Right. And the lending world revolves around making it easier for that person to buy a house. When we're talking about investment property, the barrier for entry is a little bit harder. Why do you think that is?
Oh, well, let's see. I'm not living in the home.
Right.
So
it's riskier. You're more likely to walk away from it if you have trouble.
There you go.
So if you lose your job or illness, you're more likely to walk away from an investment property than you are your primary residence. So it's going to be harder to get in there.
Right.
It's going to require more. There's more requirements. But we're gonna learn about the ways to make it as easy as possible.
All right. So what's the easiest? What's your first foremost easiest way?
I love this way, and really I learned it from you. But we've seen it over the years. You call it house hacking.
Sure.
But it's to take that first piece of property you bought or the property you're in now and turn that into a rental property.
There you go. Because you got in, hopefully, with very little down.
Right.
Right. Maybe you've been in a long time, you don't owe anything, but maybe you got a better rate because you were owner occupied versus investor, right? And so you can turn that into rental property, go buy another one, do it again, go buy another one, do it again.
Right. So the deed of trust says you're going to occupy it at least within 60 days and at least for 1 year. After a year, they don't care if you're going to turn that into rental property.
There you go.
Now, as far as buying that second house, as opposed to buying investment property, minimum of 5% down.
Ooh, yeah. So this is the easiest
way.
Or
if it's not an FHA loan, if you've converted an FHA and you're going to buy another house, as long as the house you're leaving is not FHA, you could buy another FHA with 3.5% down. Probably optimal to stay with conventional. You can also, and we call that your departing residence, you can also take that property that you're leaving, get it leased, and not have to count that payment against you in qualifying for the next property.
There you go. So the easiest way is to owner occupy and turn it into a rental.
Right.
Now, then I've already done that, Glenn.
Yes.
So I want to stay in my home.
Right.
I don't really want to move.
Right.
Or I really don't think this is a great, rental property, so I'm not going to keep it. So I want to go out and buy my first rental property. So typically, when I want to go do that, the typical loans require what?
With Fannie or Freddie, both have options for non-owner occupied property. We'll get into second homes later. But right now, if you're just going to buy it and it is strictly for investment purposes, you can do a conventional loan, bought and sold in the secondary market. We're going to say minimum of 15% down. Okay. Probably optimal to get to 25%.
Do I have to have a job for this loan?
You sure do. You're going to have to qualify. This isn't the one. We'll get to that later. This one you got to qualify for. You're going to need your down payment plus 6 months of reserves, which is important.
6 months of reserves.
And there's no gifts allowed. So you can't get a gift from somebody. Just like a conventional loan, we're going to get an appraisal on that property. We're going to make sure the property is worth what you're paying for it.
Okay.
You can't need a bunch of repairs. It's going to have
Does it need to be leased out before I buy it?
It does not, but you're going to have to qualify for that payment. If it is leased out and you're buying a property with a lease on it, then you can use that lease as income to offset that payment.
I see. So it doesn't have to be, as long as I can qualify for the house that I'm in, the mortgage I have, and the mortgage I'm going to get.
And that's going to be typical. We're going to be looking, it used to be 28, 36, but now I think it's closer to 41, 42, and 50.
What are all these numbers you're throwing?
So we're going to look at your income.
41, 36, whatever it takes. 41, 42, whatever it takes, right?
We're going to look at your payment that you're making plus all your other debts. We're going to divide that by your income. Yes. We don't want that to go over 45 to 50, depending on.
So we don't want you to have too much debt. You have too much debt, and we think, oh, you're probably not can't afford this.
Right. Another thing, when you're considering buying investment property, the better credit score you have is really going to come into play because the higher that credit score, the better the terms are going to be as far as the down
what's a
payment.
good credit score?
780 is Everything under 780, you're going to start seeing adjustment below. But I would say if I was advising you and you're buying rental property, I would make sure my credit score is in the sevens before I even started. And I'd want it to be the higher the better.
Even though I could do it with a lower
Yes.
score,
You know,
the rates
the
are going to be
guidelines say
higher.
620, right? But
Okay.
you know, when we put it into the automated desktop underwriting, the automated underwriting piece, the lower the credit score, the higher that risk model, and you know, likely not to get approved.
All right. So, is there a loan that I don't need a job for?
There is, and this one we talked about. And you know, this came out a few years ago, and I was hesitant to get started on it because I didn't know if it's going to be a fad. But now we're seeing a lot of it. I've got some expertise in working on a couple of these, doing a couple of these, so now I know about it. And it's called the DSCR.
What does that stand for?
See if you can tell me. Now you know.
I
It
don't know.
stands for Debt Service Coverage Ratio.
All right, so this is how I'm going to get by without having to verify my income. So let's just say I do have income, but maybe it's complicated.
You're self-employed,
right? Or I'm self-employed,
1099,
and
right.
oh wow, I don't show a lot of income on my taxes.
Right.
That would be a good reason. Or maybe I inherited some property and I wanted to refinance it, because I can refinance with this loan too, right?
Right. So this loan is what we call, and again, we're getting technical here, a non-QM or qualified mortgage. So most of the mortgages that we do are going to be sold and bought on the secondary market, owned by government-sponsored entities,
Like
Fannie Mae and Freddie Mac.
Okay.
Right. When we get out of that, those are considered qualified mortgages. These are non-qualified mortgages. So the banks and the lenders are still regulated. So the government, the regulators say these loans still have to make sense. So because we're not going to look at your income, what we're going to look on this is, does the rent from this property cover the payment that you're going to have? So
Debt
that's the
service coverage ratio.
ratio.
So they're going to look at the ratio of the income of the property
Right.
to the debt of the property,
Right.
and not your income or your debt.
Right.
So I could be $1 million in debt. They don't really care, right? I hope
We're
you're
not-
not $1 million in
We're
debt.
not
But
gonna, oh, maybe.
anyway, so it's all about the property and not about you. But it is a little bit about
it's
you.
about
and
you
then
in respect to
credit score.
credit score, and
what's the
reserves.
lowest?
and
What's the
cash.
lowest?
Well, again, Angie, they'll say 620. It's probably 680. Maybe there's some that would do 620, but the terms are going to be ridiculous. You know,
You're going to have a
40%
high
off, you get a
interest
higher
rate because the lower your credit, the
680
higher
is-
the risk for the
In all
lender.
practicality, it's going to be a 680 score.
So who are you selling this loan to
So
then?
these are banks, institutions. They're not going on the secondary market. So these are loans that they're going to keep. Typically,
So they're private.
They're private loans, right? Not private in the sense of a hard money loan. They're private in the sense it's
Of a
it's a
bank.
private institution. It's
An
not the
institution,
government.
yeah. Right.
Right. And typically you're going to look to get the best terms. You're going to look at probably points being charged. Probably to get the best rate, you're going to be looking at a prepayment penalty of 2 or 3 years.
Well,
But
that's not bad. I mean,
no, it's
hopefully
not
you
at
plan
all.
on keeping the loan 2 or 3 years. So if that's all the prepayment penalty time that it gives, then that's not bad.
So what we need
Okay.
a credit profile.
All
we
right.
need assets. We're going
Okay.
to have reserves.
Reserves. When you say reserves, what does that mean?
So that means after closing, you still have so much money left in the bank. And typically
Like
we're going to look
6 months of payments?
Right. 6 months of payments.
Okay. So you take your payment, say it's $2,000 a month.
Right.
I'm going to need $12,000 in the bank.
Right. And the bank means 401k, IRA.
Could mean
Asset
any, just
account,
as long
right.
as there's cash laying
Has
around
to have
something.
some liquidity, right.
And some liquidity.
Right.
All right. So
And-
I need a decent interest rate. Now,
You need
how
credit
much?
score, decent credit score.
Decent credit score. I
money.
mean, that's what I meant.
And we've got to have an appraisal.
You got to give me a decent
Yeah.
interest rate. That's all I'm saying
Right.
there. Now, if I don't have income to show that I can do this, but I gotta
So we
have
don't need
something
income.
else.
We're
You're
not
gonna
gonna-
need some cash somewhere here.
Right. You're going to have
Right?
a down payment. So 20 to 25% down.
So this is a little bit more. Your standard loan was only 15%, with a little bit of higher interest rate, I'm
Right.
sure, and
Right.
probably PMI, like private mortgage insurance.
The other
But
thing.
now you're saying a little bit more cash,
Mm-hmm.
but I don't have to have verified income of any kind.
We're not going to look at a tax return. We're not going to look at a pay stub or a W-2.
Wow.
Now, you cannot do this without owning your own home. So you can't.
You got to have a primary
you
residence.
can't be living in your mom's basement and just say, I'm going to do a DSCR loan.
Okay.
That's not going to
You
get
gotta
a
have a
primary
primary.
restaurant. And the terms are going to be better if you have experience. So for the
Okay.
first time using this program, they're going to want 25% down. it's going to get under a little more scrutiny. The good thing about this one, though, is there's no limit to how many properties you can have.
Woo.
So Fannie and Freddie don't like it if you have more. It used to be 7. I'm not exactly sure how many. Maybe they've relaxed it. But this one, I don't want to say it's infinite, but they don't really care if you own 15 or 20 properties.
Wow, so this could be your doorway to owning a lot of properties as long as the properties are cash flowing. So tell me what the ratio is. So let's just say I buy a 4-family and the payment's going to be $2,500 a month. What does the lease need? How much lease income? And
so
do
there's
you
a lot
count?
of factors that go into that. And first, when we talked about this earlier, the lease payments are going to be based on what the appraiser said. So this appraisal,
not what they actually are.
Right. So this appraisal is going to be a little more expensive.
Wait a minute. So are you saying that this multifamily could be vacant when I buy it?
Yes. Yeah.
It doesn't have to be leased out.
No, we do these all
It
the time.
could be, but it doesn't have to be all, or maybe some of it's leased out.
Yes, it doesn't matter. What we're going to go by is the appraiser is going to do a rent schedule. So he's going to go and research what rents per square foot in that area.
He's going to tell you, the banker, that this place can at least rent out for $2,500 a month if I have a $2,500
So that would be a 1%.
payment.
That would be a 1%. The ratio would be 1% because it's 100% covering lease. Now, if you
Okay, wait, slow down.
All right.
So you're going to take your monthly payment, which is principal, interest, taxes, and insurance.
Right.
Let's say it's $2,500, and if I can get $2,500 of income, I divide the lease income into by the payment, and if they're the same, that equals 1.
Right.
That's the ratio. So on this loan, do I have to have 1% ratio or higher, or can it be a little lower?
It depends on your experience. It depends on your credit score. It depends on the down payment.
So the first time I do this, I imagine it's
got
to be a little higher.
It could be 1.25, right? Now,
so does it have to be 1.25 if it's my first time, or a little over 1?
It has to be at least 1.
Okay, so it's my first time.
It's your first time. You've got 25% down. You've got reserves, and you've got an excellent credit score. Any of that changes, it might be lower. Now, on the flip side, let's say you've got good credit score, you've got experience. I've seen it go down as low as 70%.
Oh, so the leases may not have to cover it, especially if I feel like I can get more rent out of it than this appraiser is going to say.
And we don't look at repairs. We don't look at maintenance. We don't look at anything.
What about utilities?
None of that. We look at strictly the payment and the lease. Those are the two factors.
Wow. So it's all based on gross income.
Yes. And this
so you better be careful too, because this may be better cash flow for you.
Yes.
Right. So just because the lender says, "Hey, this looks good,"
and this program
it might not be a good deal if this is a high maintenance building.
This really favors the experienced investor.
Yes, it does.
And the good thing, these go quick. I mean, because we don't have to analyze your income, we don't have to do all those calculations. These things, we can close these things in 3 weeks.
Well, is there a limit on what price point I can buy?
These will go up, believe it or not, up to $2.5 million.
Wow. So this really for any place in the United States. Can it be in another state? Can I be in another state and do this?
You sure can. Yeah.
Wow.
The difficulty comes when you get to those higher units. It's harder to find comparable rents, especially in Missouri. So I know.
Can this be an Airbnb?
It can be, yeah. It can be an Airbnb. It can be nightly rentals. But we're still going to go by, when we approve you, based on what the appraiser says the rent is. That's the main focus.
Is he going to do Airbnb rent, or is he going to do monthly rent?
Monthly rents, right.
So even though you may be able to make a lot more Airbnb-ing it, he's going to look at just what if you lease it to a single family for a year.
And it's not just purchase. We can do these on refinances. We can do cash out refinances up to 70%. So there's a lot of options.
All right. A loan without a job. Wow, that's amazing. A DSCR, debt service coverage ratio loan that's sold to private institutions or banks and not the government. See, look at that. A capitalist society where you have freedom to come up with new and innovative ways of doing business, and voila, someone's willing to take the risk on you.
Yes.
So you could own a lot of properties. You could buy a lot of investment properties this way. This is pretty cool. So, So can I do this if a relative, if I buy a house from a relative and he gives me this gift of equity deal?
You can't do no gifts on this program.
No gifts at all. No gifts at all. So save your cash.
We can do gifts on the other type. You know, there's owner-occupied and owner-occupied. We haven't talked about the second home, so here's my segue to next time. We're going to talk about buying a second home or a vacation home.
All right.
Right?
There you go. Fantastic. Well, join us next week when we talk about that. And we're also then going to get into the models or the framework that you need to use to decipher all these properties that you're looking at to see, are they worth it and should I even buy it?
Yeah.
Right?
Yes.
All right. Well, I'm Angela Dillman here with Keller Williams Realty Chesterfield, and this is my wealth building partner,
Glenn Calvin at Gill Mortgage.
All right. We're here to help you build wealth,
Live your dream lifestyle.
and leave legacies that matter. Thanks for watching. Join us next week.